get this meeting underway, shall we? Does anybody else here in the chat, if you guys want to just drop a line, you just type yes. If you've traded options, no. If you haven't traded options, you don't have to answer at all if you don't want to. But feel free to just kind of drop a line in the chat, kind of give your overall experience level with trading in markets, how many years you've been doing it, and then we could take it from there and kind of see what level of in-depthness we want to get to straight out of the gate. Nice, AT. All right, so a little bit of background about myself. I've been an active trader since 2014, trading options basically every day since 2017. Previously worked at a crypto market making firm. Stranger, what's up, man? Previously worked at a crypto market making firm and research analytic firm. Did a lot of analysis there, created different options metrics, specifically for Bitcoin and Ethereum, and then have just been kind of working together with HighStrike, bringing some trade ideas there, sharing my analysis with the folks in the chat, trade ideas, etc. Just going over everything I look at on a day-to-day basis, bringing it all together for the guys and sharing trade ideas when they pop up, and just overall this methodology that I've spent a lot of time and years kind of excruciating over, figuring out kind of what is the rhythm of the market. How do I find these repeatable patterns and ultimately turn it into a trading strategy that can net me returns over time that can outpace the market, right? Because ultimately, the whole reason you should be trading is that you should have a benchmark, and you should be able to outperform that benchmark. The simplest benchmark there is the S&P 500. So if you're looking at SPY shares, they go up on average, whatever it is, 5-10% a year. If you can't outpace that 5 to 10% a year by trading, you should probably not be trading at all, right? You could just put your money in the S&P 500. No, you're going to net that 5 to 10%. You don't have to worry about all the stress. But there are ways of outpacing the market. If you're clever, quick, figure out different methodologies, trading strategies, etc., your end goal should be to outpace that benchmark. So in the case of the S&P 500, for me personally, I'm always trying to outpace Bitcoin, right? Because I know if I put my money in Bitcoin, if we look at the all-time chart here, Bitcoin tends to go up pretty dramatically over time. So I'm looking for returns that can outpace just simply buying and holding Bitcoin. It's a very difficult task to do. Bitcoin year over year, it's something up. We looked at it since last year, it's up about 20% now from last March. If you looked at it since past 2 years, it's up somewhere north of 250%, right? So how can you potentially outpace 250% gains? In the course of a couple of years, you need to access what's known as leverage. Options are the simplest way to gain that leverage, right? So anytime you're trading an option, what is an option? It's a contract that allows you to buy or sell shares at a given price on a specific date. And you pay a fixed amount of premium for that contract. You can also sell these contracts. We can get into that in a little bit. But essentially what it is it gives you the right to buy or sell shares at a certain price on a certain date, and you pay a fixed amount of that premium as a buyer. So if you were looking at, say, call options, let's pull up an example of a recent trade we took on Tesla. Look at these June 500 calls, right? So here's a chart of June 500 calls on Tesla. These expire June 20th, 2025. So about 3 months from now, minus about a week, is when these contracts expire. The strike price here is $500. Now, if Tesla comes, over the course of the next couple of months, let's say Tesla makes a huge recovery, it ends up at $520 by June 20th. The intrinsic value of this contract would be $20 because you have your strike price. It is a call option. A call option allows you the ability to buy it, right? Puts are when you sell it. Calls are when you ultimately buy it. So this call option allows you the ability to purchase 100 shares of Tesla per contract at a given price of $500 on June 20th. So for every dollar over 500 on June 20th, the intrinsic value of this contract goes up by $1. So if it's at $520, that is $20 per contract, or $2,000 because you multiply the premium here by 100 shares. Now I'm going to go slow just to unpack that real quick. In the interim, right? So right now, this contract's priced at, say, $148. What that pricing is based off of is known as the Black-Scholes model. So this is the way that market makers try to price options into the future. Kind of takes into account all these different factors: current price, historical pricing, the average move on a daily basis, etc. They kind of shove all these different things into an algorithm. It spits out a price, and they say, here's the fair pricing. Now, if you can look at higher time frame charts on something like Tesla, right now I'm looking at the daily. The lower time frame you go, so if I was looking at, say, weekly calls on Tesla, right? If I was looking at the March, say, 28th contracts that expire at, say, 270. Let's pull up those. The lower time frame you're on when trading options, the more efficiently these contracts are going to be priced. So what does that mean? That means here we are. Here's these 275 calls that expire this Friday. These are going to be an example of an extremely accurately priced contract. They're about $4.90 now. Odds are we're going to see price probably expire come this Friday somewhere down between 285 and 250. So that $490 a premium per contract is what's known as a fair price. It's very efficient. Your ability to beat the house on the shorter dated options is very small. Remember, with every options contract, there's a buyer and there's a seller. So it's a zero-sum game. If you make money trading options, by nature of the game here, somebody else has to lose a lot of money. The person on the other side of that trade is a market maker, right? So think of Citadel, BlackRock, Wolverine trading, like all of your big name hedge funds, market making firms, people with billions and billions of dollars that have a lot of years of experience in markets. They can push price in whatever direction they need on lower time frames, 9 times out of 10. That's who you're trading against. So your ability to win more often than you lose when playing short-dated options, the odds are not in your favor. Now, where you can get an edge is if you go out, say, 2 months, 3 months, 6 months. If you can project a read on higher time frame charts, like I said here on Tesla, I'm looking at the daily chart, right? So if I can look at the daily, weekly, monthly charts, piece together a trend, and at the same time, I can see a situation where my risk is low and my upside potential is high, right? So, for example, on these June 500 calls here on Tesla, they're currently trading at $148. I bought these a week ago at around 80 cents. And as we can see back in December of last year, when Tesla was trading above $490, these same contracts that I bought for 80 cents a week ago were trading over $94. So there's a huge discount there, right? Between the price that these once traded at a few months ago and the price they're trading at now. However, when I look at this chart, if I was looking at this in December, I would be much more bearish on these contracts, ironically, when they were trading over $9,000 than I am now that they're trading at $1.50, because look at the difference here. So your edge is going to come from being able to read high time frame data when it comes to options markets. So if you were looking at these Tesla calls in December, if you remember, if you were trading back then, the common theme of the market, right? Everybody was looking at Tesla saying, okay, it's going to go to $1,000 basically in a straight line, right? So you're having people bet on this kind of irrationality. The stock had already would go up 2.5x in the matter of 2 months, right? And if you looked at something like the RSI here on the daily, all the way at 85, it just can't sustain. Price action cannot sustain itself. This is a sentiment indicator, one of my favorite technical tools, and this was just showing us how overbought it got. So we reached this kind of point of irrationality. Price cannot continue on this trajectory this far into the future. However, if you were to look at these contracts, they were trading like it would. So the implied pricing, remember what we were saying, if you took the options premium that you pay for this contract, you add it to the strike price. If you were looking at these contracts back in December, the price you would need just to break even, right? If you bought these 500 calls at the end of December, you would need price to get above 594 by June just to break even on these contracts. Now, if you would have bought them this week or last week, you just need price to get to $500 by June period, and you're already above your break-even price. So there's this huge gap there. And as price came down over the course of the past couple months, what you had is all this irrationality that got priced in at the top that got drained out, right? So price comes down. You still have people buying the dip here. They're trying to buy calls. If we would overlay this on top of the price chart of these June calls, for example, here's the peak. It's at 95. It drops down to $5,000, comes back up to $7,000, right? They're still extremely overpriced this whole way. And then what we see, you can actually see this, right? Like, is the capitulation happening in terms of the implied volatility to the upside. So as the options market starts to drop down, you could look, I'm just looking at these 500 calls for an example, but you could have looked at, say, the March 400 calls. You could have looked at the April 350 calls, like any kind of call contract you were looking at. If you pull up this chart, and you guys can do this in TradingView, by the way. I like to use bar chart, but you could also use TradingView if you want to see a specific contract just to understand the value of pricing you're paying relative to where it's been. You can just type it in here and it'll pop up. Type in the ticker, expiration date, and then put or call, and it's going to pop up and give you a nice price chart. But if you're overlaying it, you can just see the kind of euphoria sucked out of the market, right? So back 3 months ago, everybody wants it. Then as price goes down, people give up on it, right? But as you know, if you've been trading for any substantial amount of time, the point in time when the risk reward is most in your favor, and this couldn't be any more true of options, is when there is the biggest capitulation. When people are forced to sell who never wanted to sell, when people give up on a stock that they bought 50, 60, 70% higher, and then they're forced to sell because of margin requirements or because they just can't take the pain of looking at their account every day and seeing it going down. Anytime you kind of have those dislocation events in markets, you can be certain that the options market is providing you with an opportunity to take advantage of what could just be a reversion squeeze, right? So when I bought these Tesla contracts last week, like I said, they were trading at around $80. In about 3 days, they went from $80 to like $250 at the peak last week, or at the peak, I'm sorry, yesterday. So just on this small move up, I think I bought them when Tesla was around 230. And in the course of about a week, it just bounces back to 288, right? So I'm trading an option that's 3 months out. It's extremely far out of the money. Tesla basically needs to double from here for this contract to get in the money. But just on this small $50 move on Tesla, right? Just this 20, 30% bounce back it's had in the past week, those contracts go up 3x. So if I was trading shares, I could have made 30%. Cool. But also if I was trading shares, I'm going to have to deploy a whole lot more capital to get the same kind of upside that I can get from options. So for example, when I'm trading options, I'm typically trading anywhere from like 10 to 52 contracts at a pop. So these contracts were around $80. I think I bought around 32 of them. So it was about a $2,500 trade, give or take. That $2,500 turned into like over $5,500. Yesterday, when it squeezed up to the 200-day, I was able to remove my initial investment, the $2,500. And now I can keep the remainder of that trade open as long as I want, right? So I could choose to sell it tomorrow, take the rest out, it's all profit, or I can see how far this can go. Like we were saying, you look at this contract, right? And we also look at the daily chart here on Tesla. If it's able to break above the 200-day, I don't know if it's going to be this week, but I could see it happening in April, right? I could see this move coming to 330, potentially up to 370, right? If the squeeze really gets going. Because what we have is a lot of short interest trapped. So with this amount of short interest trap, you never know how irrational the market can get in the near term. Anytime there's kind of a short squeeze underway, you have things get as bearish as they've gotten in the market over the course of the past month. Goes down a straight line, you can see that kind of equal and opposite reaction play out to the upside, and maybe we get a drastic move to 350 plus. If that happens in April, these contracts that I bought for 80 cents could be worth as much as $4,000 a piece if the squeeze happens rapidly, right? So the beauty of options, if you can find these kind of low risk, high reward setups that I'm constantly looking for, is one, it costs you very little capital. So like I said, I bought 32 contracts. That represents 100 shares per contract. That's the equivalent of buying 3,200 shares, 3,200 shares. If I were to buy 3,200 shares of Tesla, let me just add up that price. So if I were to do that last week when Tesla was trading at 230, I would have needed to have around, let me see, 100. I would have needed $736,000 of buying power. And on that move up, I would have made just 20% on it. Yet I can still access that kind of same leverage to the upside, right? That would have cost me $730,000 plus. I was able to get that kind of upside for just $2,000 of risk by buying 32 contracts that expire in June, out of the money, etc. So now I'm at a point where the remaining contracts I have, they have this infinity upside, right? I've already de-risked. I've already taken out my profits. I've already taken out my cost basis. And now what I'm playing with is just house money with 3+ months to expiration. And the way it goes from here, like we're saying, this could go any number of ways, but this is kind of the methodology that I've learned over time how to take advantage of what's known as call skew. So call skew, again, to go back to the core of options, the way that options are used by institutions, right? They're contracts. Like we were saying before, they represent the right to buy or sell 100 shares at a given price on a given date. The way you typically will see options used, if we looked at Tesla, for example, you have a lot of pension funds, hedge funds, etc., just smart money retail traders with millions of dollars in their account. What they will do is they'll buy large positions. So if an institution is taking a position in Tesla, the way they will fund that position, they will buy, say, $1 billion of shares against that. Say they have 10,000 shares. They buy 10,000 shares with cash. Then they take that and they sell contracts against it in the future. So they'll sell these call contracts. So when Tesla was trading at 9,000, I'm sorry, these Tesla June calls were trading at over $9,000. There was somebody here who owned shares, most likely, that saw how ridiculous this call premium was. They weren't ready to sell their shares entirely, but what they likely did is they said, okay, well, I can go out 6 months to the future, write these call contracts against my position, right? I own all of these shares so I could short these contracts. Then as these contracts come down in price, they collect that premium. So for every contract that they sold or shorted up at, say, $7,000 to $9,000 3 months ago, that's turned into profit as these contracts have depreciated. Then they take that premium they collect by shorting these calls and they buy puts. Puts are contracts that will pay you as price goes down, right? So the same way that calls go up when price goes up, puts go up when price goes down. We were to look at, say, Tesla 400 puts for the week of April 17th. We can see how these have changed in value over time as Tesla dropped, right? So all the way back in December when Tesla was at its peak, these puts, these are the 400 put that expires on April 17th, which is about 3 weeks away now. These were trading around $3,000 in December. So still a lot of premium, and that's because puts are always being bought. So calls are always being sold by institutions. So calls, which give you all this upside if price goes up, they're always going to be much cheaper than puts. So even when Tesla was at that extreme, it was all the way up at 490 or so, these $400 puts were still going to cost you $3,000. So you're still risking a whole lot of risk premium to buy these. Now it obviously worked out. They traded upwards of 126 or I'm sorry, 182. So these were over $18,000 a piece at the peak. They're currently trading for around $12,000 a piece. Still made good money, but you had to risk a lot more capital. So puts are always going to cost you more money to purchase than calls. So if you just know that as a standard way of operating, right? If you understand that out of the money puts are always going to cost you more than out of the money calls when you're trading on any stock or index, you know that your best risk reward, especially in a market, I mean, obviously the past couple months here haven't been too great, but over time, the market is designed to go up, right? So the market's always designed to go up, yet you can buy the upside for much cheaper than you can buy downside protection. So there's this kind of natural discrepancy there where calls are always going to be at a discount due to this factor of funds buying shares and then selling the calls against it. Because as more and more people sell a contract, it drives down that premium. Then that premium is not going to spike until you get the spikes to the upside. Like if Tesla were to go on a run, like we were saying before, it goes back up to 350. then we can see these contracts go back to $4,000, $5,000, etc. And you see those big spikes come, but they're willing to sell you that upside for much cheaper because they're just constantly trying to get that yield against their shares, right? You can think of it like they're long structurally by owning the shares, and they're just trying to make that position pay for itself by continuing to sell upside volatility against that position. Now, I know we covered a lot there. I'll just check in with the group and see if that makes sense so far. If you guys have any questions, anything you want me to slow down on or unpack a little bit deeper again, just feel free to drop it in the chat. One thing we could talk about too is Bitcoin in specific, because it tends to be an outlier. So this was actually a subject that we covered in today's newsletter that was published. But Bitcoin is, like I was saying before, when you're trading any individual stock, be it Tesla, Apple, Google, Amazon, you're always going, if you took a call at, say, we'll use Tesla for example. If I were to look at a call at $370, so $100 out of the money, and we could just pull this up for example purposes here. We'll go Tesla 370 call for June of this year. So this call is $100 out of the money, right? Costs $810. There's 3 months to expiry. If I were to look at the Tesla June 170 put, sorry. For June of this year, 170 put. This is going to cost $410. So there's this natural kind of inverse correlation where if you take an out of the money put, it's usually going to cost you more to buy that than it will a call. With the exit, like there's going to be outlier scenarios where if price is moving too dramatically, then those things could get out of whack. Now, Bitcoin's one of the few things where the call skew, where the put skew is constantly in favor of calls. So rather than puts costing you more money than calls are going to cost you more money than puts. What's been happening recently with Bitcoin is that this has gotten a bit out of whack. As there's been more and more fear in the market, we see that now if you were to take a 25 delta put, it's costing you about 7% premium to buy the put with 1 week to expiry, and about 2.5% with 1 month to expiry. You're going to be paying more for puts than calls on Bitcoin, and this is kind of an outlier. If you look at it over the course of years, it doesn't really happen with this much sustained action. It's only happened after the August crash and then now. So it tends to be kind of a good signal. Anytime the options market is overpaying for something in one direction or the other, these kind of skews get out of whack, and it tends to make it ripe for reversion over the course of the next couple months. So don't be surprised if at this point, because what that data is telling you is that calls on Bitcoin are basically as cheap as they've been since September of last year. If you would have looked at Bitcoin in September of last year, that was right when it was consolidating around 57 to 60,000. And then we all know what happened within a couple months of that. So if you were to look at Bitcoin right now, this is probably a great time to be buying longer dated call options on it, right? So you could buy, if you're trading in a brokerage account, you could probably do something like buy out of the money calls on IBIT that expire in, say, December, September, and more likely than not, you're going to make some money on those if the same pattern plays out. So let's take a look at, say, IBIT calls for, take a look at the 70 call for September. So these are currently at around $250 a contract, about 3,000 contracts open interest here. And these were trading at a high of over $700 just about a month and a half ago in February. So this is an example of a good setup here where you're essentially risking $250, right? But with that $250, you have all of the exposure to Bitcoin's upside over the course of the next 6 months. So now through September 19th, if Bitcoin does, say Bitcoin goes to 250K, right? Goes up 3x. That would bring IBIT to a price of $150. At that point, these contracts that are currently trading for $250 are worth over 18,000 a piece, right? So you could turn $250 into $18,000 potentially. Now, is that likely to happen? No, but the setup is there, right? And it's as cheap as it's ever been. And you kind of look at this data, like we were saying with the put skew, anytime it gets as out of whack as it has been for the course of the past couple of months, that tends to signal a bottom. And your risk reward is just skewed. So it's skewed heavily in favor of calls being rewarded here. Now, is it a sure thing? No. But it's a matter of playing enough hands, right? Like this is the situation where the edge is in your favor. Is the edge in your favor buying puts when this put skew is this high? No, it doesn't mean that Bitcoin can't crash. It just means that it's all priced in. Like anytime you see the put skew going nuts and trading near 10%, this is just telling you that the market's extremely fearful. And if everybody's fearful, it's already priced into the market, right? 9 times out of 10 is. It doesn't mean that the market can't crash for exogenous reasons, right? It could still find a way to potentially drop to 50K in some kind of black swan scenario. But more often than not, 8, 9 times out of 10, we're probably closer to a bottom than not. So if you look at it over the course of 6 months plus, they're giving you that upside volatility away cheaper than they have at any point since September, when IBIT was trading all the way, or I'm sorry, Bitcoin was trading all the way down near 50, low 50Ks, or high 50Ks, low 60Ks. And it obviously went up over 40%, 50% in just the span of a couple months. Now, if you were buying calls at this point in September, right, look at all this upside you could have potentially got. So if you're doing it with IBIT contracts, we could just take a look at how those changed over time last year. Let's take a look at the IBIT. So in September of last year, it was at $32 and it went to a peak of 60. So we'll say IBIT 2024, and we'll look at the January 27th calls. So these were calls that expired in January or December of last year on IBIT. It's not a great one. There wasn't a whole lot of open interest. Yeah. So if you're looking at these before the election, this one doesn't have stored data. Not working. Essentially, you could have probably bought the same kind of setup here. If you were looking at, say, $40 calls on IBIT that expired at the end of December, if you were looked at it in the September period while we were chopping around, you could have probably bought those calls for anywhere from $150 to $300. Then by the end of the year, they were worth over $2,000 a piece. So that's like a 10 to 20x move that you could have got by taking advantage of this call skew when it got out of whack and people were overpaying for puts relative to calls on Bitcoin. It's kind of a very rare signal, pops up 1 to 3 times a year roughly, where it's this sustained, and it's tend to lead to the biggest reversions over the course of the next quarter or so. Let's see, I got a couple questions in chat here, so let me get to these. How do you identify that this is the particular week of the option where you get interested? Now, that's a good question. What I usually do is I look at quarterlies. So it all depends. Like if I'm looking at a chart specifically, let me show you a good example of this. I did this pretty successfully over the course of the past couple of years with MicroStrategy beginning in 2022. So MicroStrategy, I began trading this late in 2022 because there was a pretty dramatic amount of short interest on it. So as you guys may or may not know, MicroStrategy, the largest public Bitcoin holder, they've been the largest public Bitcoin holder for years now. But they started this whole strategy of buying Bitcoin, selling their own shares, raising capital, and just adding Bitcoin to their balance sheet all the way back in 2020, 2021 during the Bitcoin bubble of that time. Bitcoin went from like whatever, $3,000 to $70,000, then crashed. And when it crashed, there was an extreme amount of short interest on it. So strategy went from $133. They did a stock split previously. It was like $1,300. They did 10 to 1. But anyway, if you looked at this, it was at 133, crashed down to about $16 or so, somewhere around $20, I believe it was in 2020 when I started selling out of the money puts on it because it had so much short interest. So like what we were just talking about with Bitcoin, right? The put skew is out of whack. The put skew is out of whack because there's a whole lot of people betting on it continuing to go down. The more people buy, and this is true of calls too, like we were talking about on that Tesla example, the more people are betting on a direction of price, right? So if everybody's crowding into puts, puts become very expensive. If everybody's crowding into calls, calls become very expensive because the market maker has to constantly hedge their tail risk. So if I'm a market maker and I sell one call, I don't have a whole lot of tail risk if I sell one call to a retail trader. If I'm a market maker and I sell 10,000 calls at a certain strike, now all of a sudden my tail risk, like we were saying before, there's always somebody on the opposite side of your options trade. So if a market maker sells 10,000, 20,000, 30,000, et cetera calls, they have a whole lot of tail risk if the trade goes against them. So they constantly have to charge more and more money for those contracts as more demand comes in. So what I saw at this time back in 2022, I looked at it, I study Bitcoin pretty intently. I've done so for 10 years now, and I knew, okay, Bitcoin's not going to zero. This is likely the bottom or close to it after the FTX collapse. But if you were to look at the MicroStrategy pricing in the contracts, this extremely strange phenomenon was happening where you could look at the time, they were $500 puts that expired at the end of 2023. So this was at the end of 2022. Price, if you adjusted the share after the 10 to 1 split, it would be like selling in the money puts at $50, right? And they were giving you this huge premium. So they were basically betting that the price was going to zero in a straight line, and you were able to sell the put. So like we were talking about before with intrinsic value, these puts wouldn't make money unless price went to, I think it was around $10, but the price was at 18 and it was already down, whatever, 90% from the highs. So there was this huge gap between what they were willing to pay for the puts and what you could sell them for. So I started to sell those puts, and then I would take the premium I collected and buy deep out of the money calls with it that were quarterlies. So back to your original question, how do I select the expiration date? So what I would say is I like to look at quarterlies most likely. So if I have some kind of read on a chart, if I say, okay, I like this setup here, I look at the pricing, like for example, on the Teslas, right? There's a reason why I selected June. June is the end of quarter two. So that June 20th expiry brings us to the end of quarter two. If we looked at Tesla, it's just been a horrendous quarter one, right? Quarter one has been as ugly as it gets. Quarter four of 2024, that began in October. So here we were in October. We were at $264 when quarter one opened or quarter four opened, and we ultimately closed the quarter all the way up at 460. So over the course of a quarter, you get really clean trends. And as we've seen, quarter one of 2025 has been horrendous. But anytime you get these big exaggerations, be it to the upside or the downside, the odds of the following quarter resulting in some kind of big reversion, again, it doesn't need to last the entire quarter. Like we were saying on Tesla before, if it spikes to $400 within the next month, those contracts are probably going to be worth $3,000 to $4,000, right? The same contracts I paid $80 for. So I just need one spike within this quarterly time frame to make a potential 10, 20, 30x on that position. Then I can sell. I don't need it to get into the money, but I'm just playing for that spike. And things just don't go up and down in a straight line. As anybody knows, markets like very rarely, like Tesla's gone down a straight line since December, right? So the odds of this persisting for another 3 months I'm not saying it's not going to go lower throughout the course of the year, but the odds of it just going straight to 120 without some kind of big reversion spike here in quarter two are very unlikely. So if they're going to sell me that kind of upside, like we were talking about in those June calls for very little, I'll take that for the following quarter and see if I can't get a big spike to the upside. So I'm always looking at quarterlies. Now, if nothing were to happen, say I took this Tesla trade, bought those 32 contracts for around $2,000, nothing happened, right? Maybe I just lose all my money, lose $2,500, and price just either stagnates or keeps going down throughout the course of quarter two. What I know then is, okay, can this persist for 3 quarters in a row, right? Like the longer it takes for this kind of big spike in either direction to play out, the greater your return is going to be because those contract premiums are going to continue to deflate. So if I waited it out through June, nothing happens, there's never any spike. The September calls, and I could pull up these here, say the Tesla 500 calls for September of 2025. So these are September 19th. These are going to be your end of quarter three calls, right? So these traded as high as 112. So it's about $12,000 a contract. That's what these were trading at in December. The next 3 months come and go, and Tesla never breaks above $300. By the end of June, these are likely going to be around 80 cents, right? So I'll just play that same hand again because I'm not risking more than whatever I put into the contract. In my case, I'm risking like $2,000 per hand. But if you're a smaller trader, you could just buy one contract, buy 2 contracts. And all you need, like if you know that the odds are in your favor in this kind of fashion, and this, I think since I started HighStrike, we have about a 7-1 odds of us hitting a double, basically a 2 to 20x. We have 7x greater odds of hitting that than we do a trade just totally not working out. So I know as I'm doing this, and I know what I'm looking at on the daily and weekly timeframes, I know how to read this data. I know that over the course of quarters, the longer it takes, the bigger my eventual payoff is going to be. So I'd be content to roll that $2,000 into September if I had to and wait for it to play out for a bigger hand. So I'm always looking at quarterlies. In a long-winded way of explaining that. Explain call skew again. So call skew, if you looked at an out of the money put, that was say a 25 delta call. So a call that's 25 delta out of the money, you weigh that against a 25 delta put. That's essentially what we're doing here on this Bitcoin chart, right? When this goes up, this is showing you that contracts that expire in 1 week, put contracts are trading 7% more, same distance outside of the money, are trading 7% more than calls, same distance out of the money. It's very typical for this to be negative. So that in Bitcoin's case, this is when it's cheaper to buy puts than it is to buy calls, because obviously price can do crazy things and everybody wants that unlimited upside. At the times when puts are costing a lot more money than calls, it's telling you that the market's kind of overly fearful, and it's basically the best time to step in as a call buyer historically, because that's how you can get those biggest reversions. So calls on a relative basis for Bitcoin right now are as cheap as they've been since September relative to puts. How do I plan my trims and the cost basis removed? Is it fixed like 20, 50% and so on? No. This part takes a lot of discretion and it comes with time. I wish there was an easy, systematic way to do this. Sometimes there is, sometimes it isn't. A lot of it is touch and feel. So I've been trading options for like 8 years. So a lot of it I can kind of tell on a relative basis when price is reaching like a local top. Like when I took the trim on Tesla earlier this week, I bought those calls. I think it was last Tuesday. Sometime last week, I bought those calls at 80 cents. Tesla comes back up. It runs into this major resistance level, right? The 200-day moving average. Now, could price conceivably have just continued up and squeezed to $300? Sure. But I think at the time, those calls that I bought for 80 cents were at $180, right? So they went from $80 to $180, a little more than double. So my $2,500 or so investment had turned into over $5,000. And you look at it and you say, okay, well, here we are, price is at resistance. I have an easy 2x that's just staring me in the face. but I have all of these contracts, right? So I'm not going to hold the entire position if the market's giving you a free 2x. So what do? Took out 20 of them, right? Sell 20 of them for $180 a piece. You remove your cost basis plus a little bit of profit, and now it's just a house money trade. Now I couldn't care less, honestly, what happens with Tesla between tomorrow and the next 2 weeks, because it's a free trade, right? It's already paid for itself. So it removes the stress of it because I've already taken profits, I've taken my cost basis out, and now I'm free to let the market do what I want, and I have ample exposure if Tesla does the incredible, right? Maybe Tesla goes to $480 within 2 weeks. Now these calls are right back to where they were trading at in December, right? And I essentially paid no money for it. I've already removed my risk, I've removed profit, and I'm just free to ride this trade for the upside potential. I know it sounds crazy, right? Like who the hell turns $80 into $8,000? I've done it by doing the same method, right? Because it's the poker analogy. You're just playing so many hands. You sit at this table enough, it's like playing a slot machine, but rather than the slot machine being designed to be in the house's favor, if you have this kind of edge where you could read these higher time frame charts, you understand short interest, market positioning, etc., the odds flip in your favor. And if you play enough hands, sure, you're going to lose some. There's plenty of I lose trades all the time. I buy contracts and they expire worthless. But what matters to me is the process, right? So I'm following that same process. It's not always going to work, but the times it works, I can hit 100x, right? I hit 100x trade that takes care of 100 losers. I'm not going to have 100 losing hands, but all you need is like those kind of outlier scenarios, like we've hit pretty frequently in the trading room, especially in Q4. It got pretty nuts. Like you just need the market to turn your favor, enough things to start like flipping bullish. You get the NASDAQ going up, etc. Can even work to the downside too if you catch it before a big VIX spike. I missed it this quarter, but there's been times where I've caught the VIX on massive put spikes, and that's been some of my biggest wins to the downside. It's just playing enough hands, understanding the way these dynamics work, and ultimately understanding how to bring yourself to a position to where you can get essentially a free trade, right? You want to collect as many of these lottery tickets as you can while expending as little of your capital as possible. Put yourself in a position where you can stack it up. Yeah, that's right. It's all macro driven. So if you understand things like the dollar, bond yields, positioning, etc., like that's a lot of it. I'm trying to simplify it just for the sake of options, but these are all the things that we cover kind of in the HighStrike trading room, especially in the alpha program. Like we're always going over just breaking these things down into a macro level. Like one of the favorite stories I have for the HighStrike trading room, last December, we were talking about capital rotation and macro, right? So one thing we were talking about is how capital rotates in a dollar bear market. So what we knew going into this year is one way or the other, the dollar was going to start falling. The dollar index, also known as DXY, had very clearly come near a top towards the end of 2024 into 2025. And what I was explaining to the alpha group when this happens, people have all these different narratives and preconceived notions. Oh, Trump's going to be bearish for Chinese stocks. Chinese stocks are going to be bearish because Trump doesn't like China. Trade war, tariffs, yada, yada. If you understand correlations, you understand macro, you know that's just a story, a flavor of the week people are spinning. Look at what Baba did when the dollar went into a bear market in 2020, right? Look at it during the last Trump presidency. So here's DXY in this pink line, and here's Baba. You can see as the dollar sunk down in 2020, 2021, Baba goes on this wild run up, right? Makes huge highs, and then the dollar comes back up, Baba dies. And now what's happened so far in 2020 or 2025, basically the day that the dollar topped, right, like almost to a T, the dollar tops here on January 6th. And since that point in time, Baba's up over 50%, just about. So I was explaining this in December to Alpha. I didn't even take the trade myself. One of our traders there in Alpha goes ahead and buys a bunch of Baba 150 calls, I think for January 2026. And he's up something like 30 grand on like a $500 investment. Just by It's the same process I was telling you guys. You just look for these situations where your risk is limited. You have some kind of edge, be it in macro, your ability to read high time frame data, correlations, exactly whatever your niche is. You figure out the optimal risk reward, a trade that you have a lot of confidence in, something that the options market isn't pricing in yet because their models are flawed, right? So if you know that their models are flawed, number one, over the course of time, they're not statistically reliable. Like we are saying, if you go shorter dated, the more shorter dated you are, the more accurate those options are priced. Further out you go, the bigger of a discrepancy you have the advantage to, you have the ability to take advantage of there. So you can capitalize on the market making's inefficiency the further out you go. It's exactly what this young man did. Now he's up 30,000. He's out traded us all this year just by buying and holding Baba calls for the past few months. I think he finally cashed them out this week. So a great trade. And it's just an example of what I always preach to the guys in Alpha, or at least try to get across there, is just how potent understanding these things and understanding the massive discrepancy between risk and reward is when you're trading options, right? If you were trading shares, it'd be a lot harder to control that risk. But if you can buy a position and you can buy it with a size that doesn't affect you, right? So if I'm playing like exactly what I said with Tesla, 32 contract trade, $2,500, I'm not going to lose sleep over that. But my upside potential on that, massive, right? That those remaining 10, 12 contracts become worth $10,000 a piece. That's real money, right? That's 120K that I basically spun up from thin air by just taking a low risk, high reward setup. And I've hit those kind of trades enough. I understand how this game works, that's the kind of approach I'm constantly trying to deploy and teach to other people. And hopefully with this kind of seminar here, some of that's helping you guys out. I think we have, it's going to be choppy the next few months. My honest outlook on it, I'm hoping the squeeze wasn't it, but this might be as good as it gets here. So we came into the 200-day, ran into some resistance. What I'm probably expecting is move up after that Liberation Day, probably come down a little bit into the end of this week, and then a move up after the Liberation Day tariffs are announced. And then we're probably just in for some chop in quarter two. And then I think we do have a setup here, quarter three into the end of the year, to make a run towards all-time highs, but it's going to be tough. There's a lot of market needs clarity right now, right? And there's just not a whole lot of clarity. I think everything's pointing to them getting interest rates down, increasing small business lending, increasing liquidity in markets, but we're ultimately going to have to see some follow through there for it to come to fruition. Right now, there's just not enough certainty. I have kind of my macro views, but it doesn't matter unless the market confirms it. So I see a setup there for us to recover some trends here in quarter two. And if we can just chop, I don't think we're heading to all-time highs till at least like July. So if we can just kind of keep structure here and not make new lows, just continue to form a range throughout quarter two, I could see us having a pretty explosive quarter three and four, and a run up to like 2,500 potentially on NQ. But that would be best case scenario. Leaning towards that for now, but we're just going to have to wait and see what the rest of this week and ultimately next week's Liberation Day announcement hold. Thank you. XRP. I don't like it, Angela. I think it's cooked. Check it out. Yeah. You see, this is like, it's already up so much. Not to say it can't go up more, but this seems like a situation where you've already missed the move. Maybe its best case scenario is $5 or so. But I think Pepe offers you a lot better risk reward. It's a lot further removed from the all-time high. I could see something like Pepe going up to 100x essentially. As we're XRP, I think you're looking at 2 to 3x. So I think there's better risk rewards out there if you're going to play altcoins. They're all extremely risky, so you might as well go down the risk curve into something like Pepe that gives you a lot of, yeah, that's right, Nate. Something that gives you a lot more upside than something that's already had its big move. and we cover a lot. So do you guys have any other questions in regards to everything that we talked about today? Anything at all, like just in terms of how this all works, just trading options in general? I know I threw a whole lot of information at you guys, so don't feel stupid. This is what it's here for. I just want you guys to ask questions, fire away, see if there's anything I can help you out with. Shoot. Also, guys, I want to make you guys aware, like, we're going to do a homework assignment at the end of this for you guys that are interested. You can send it in to us. Then we're going to take time and review it as a team, right? So not just myself, the other two trading instructors at HighStrike, we're going to take a look at your homework. For me, it could be something like fill out a trade idea, right? So you kind of everything that we were just discussing, we were going over options pricing, using these bar charts to look at the historical pricing of options, looking at daily, weekly charts. Something we didn't even have time to get into today, but we're always covering in the HighStrike room is max pain, right? So this is showing you this data here. It's going to show you how the market is positioned for every expiry. So if I wanted to look at, say, the NASDAQ QQQ, I can come out here to the April 17th expiry. What this shows me is all of the open positioning in the options market. And this is extremely powerful data because what I can see here is exactly how the market's positioned, right? So like we were saying, the house tends to win more often than not. That's why Citadel, JP Morgan, BlackRock, etc., why they all make so much money, right? They all make money because they're better at trading than most of us. They can manipulate markets. They have enough capital to put price where they need it. So if you can look at this and say, okay, the max pain price that Citadel needs QQQ at on 417 is 490, you can do a lot of trade structuring with that information. Likewise, if you see price break above key levels, like obviously 490 is a key level due to the amount of puts open at this level, 29,000 put contracts, 44,600 call contracts. So we can say beyond a shadow of a doubt, if price breaks above 490 and sustains above it for, say, 2 to 3 days before April 17th, there's something that's called gamma that takes hold here. So this affects how dealers position themselves, how they have to start hedging. We only have about 5 minutes left, but these are things that we cover very in depth every day on our morning audio in the HighStrike trading room, and especially in the alpha sessions, understanding these dynamics and ultimately how to take that information and turn it into profitable trades. So I just want to help you guys understand that as best as possible, and any questions or things that I can kind of help underscore further and illuminate here before we wrap it up, just give a quick shout in the chat there. Yeah, to complete the homework, guys, if you guys are interested, for anybody that wants a little bit more in-depth understanding of options, right? If you understood some of this, you want to understand more, you want to learn how to trade more effectively, maybe even trading like zero DTs, right? The worst possible way you can trade options. For all of the reasons we were talking about before, you are trading against the smartest and best traders in the market in a hyper-efficient game. It's a losing battle. You're not going to win consistently. You're not going to hit massive gains even on zero DTs and sustain it, right? Like it's just I can't explain how terrible the risk reward is of trying to trade zero DTs. Not to say you can't win, but the odds are not in your favor the same way that like everything we were discussing, right? It's all about finding optimal risk reward. Think of it like playing poker. Everything that I just discussed to you about, right? That's like playing poker, a game where you can have some kind of statistical edge and win more often than not. If you're trying to play zero DTs, you're essentially going to the slot machine, right? Totally, for the most part, it's random chance. And there are so many extra external factors that are outside of your control that you don't even like the hidden hand of markets that most people don't even understand that they're going up against when you're trying to trade these contracts. It is, if it weren't a massive moneymaker for Citadel, BlackRock, etc., they wouldn't sell them to you. They wouldn't let you play it if if they were going to lose money doing it. They sell them to you because it's an easy way for them to make money by doing nothing. Volatility crush, that's why they create zero DTs. is they juice up volatility. So let's like take a look at something real quick. We'll say QQQ 480 puts that expired today. So here's a good example. This was a contract that expired earlier today. At one point in today's trading session, it was 144, and then it expired worthless because there was volatility crush. So QQQ looked like it was going to make the big breakdown earlier in today's session, washed out all the way down to 482 as it got to those lows, right? Its price is falling, and then it just kind of stops right before the bigger breakdown that would have paid these contracts off. So they spiked up for a little bit, and then they ultimately expired worthless. Volatility crush is just the mechanism at which market makers bleed the premium value of your contracts to zero. So if a market maker sells you a put or a call for, say, $500, the call expires in a day or a week. Volatility crush is what they do to make price go nowhere. So those days when you're in a options position, short dated, and you're just begging the market to please move in your direction, and you look at the chart and it's just going sideways. That's vol crush 101, common tactic used by market makers, and it is extremely effective, and why they make so much money is because they sell those premiums. Another thing we could teach you to do in the HighStrike trading room, my focus is primarily on options buying, but you guys have probably seen other webinars with Sage. Sage loves option selling. So he's always the person that is looking for these overheated premiums. If we were to look at, say, those Tesla calls, he would have been the person that was selling them at $9,000 all the way back in December, as opposed to me, who's mostly waiting on the sidelines, waiting for those opportunities when I can buy them cheap. Sage is looking to sell them high. So we can actually teach you both approaches to options trading, be it buying or selling. Can break it down any way you guys want. So again, if you guys are interested in learning more, if you guys want to dive in deeper with options, kind of go over these kind of topics each and every day, fill out the homework. Send a screenshot of 2 to 3 option setups based on everything we were discussing today. Email it to support@highstrike.com, and our team will reach out to you and give you feedback. And if you're interested in working with me and the other coaches directly, there's a form for you in the chat there that Nate dropped. It's a type form. You can see it right in the chat of this discussion here. Click on that link. It's going to bring you right to a landing page. Just fill out some basic information about yourself. Join us in the HighStrike trading room, man. We're going over this day in, day out. We're just constantly looking for these setups. We're just digging for them. This is my full-time job, right? So throughout the course of every trading day, I'm spending every bit of my mental capital looking for these kind of massive setups that can make myself and the other members in the room tremendous returns on investment. So if that sounds interesting to you, if you're ready to stop losing money trading 0 DTs every day of the week, come join us. Thanks for hopping in and joining me on this webinar. I had fun discussing it all with you, and look forward to seeing you guys hopefully soon in the HighStrike trading room. So come join us, guys. Thanks.